All right. Good morning, everybody. We made it. So it seems that, with Powell tripping over his own feet and providing a mixed message, the market really didn't get it. But the ECB got it done. Christine Lagarde come out and put her foot down like a boss, kept the reporters in line, answering questions, clearly articulating that there's no pivot, there's no pause, we're not slowing down, we're not going to deviate from the plan. And the market got the message and down we went. So get her done. We have Dali speaking today. It is kind of like a speech. So probably want to look and see if this is even a live speech. It could be, something that is pre-recorded. See if there's going to be questions afterwards. I don't have the answer on that, by the way. I was reading through the morning and haven't had a chance to look yet, but that would be something, because if it's a pre-recorded speech and there's not going to be any questions, it's likely not going to cause much of anything in the market, right? But if she's live and there's questions afterwards, there's certainly the potential for her to say something market moving. The bond market also too seems to really feel that the Fed is pretty close to whatever target they're aiming for. So either the bond market is wrong, or the Fed really is getting near that spot. How we close this week is going to become very important. We have a significant engulfing candle, but it still needs to finish up. We have PMI today at 945, and that will be a wrap. That rig count should not provide any sort of market instability or volatility today. I used to work on those rigs. The number doesn't change by much. Now I say that, but say something really significant happened, like a massive recall on a new flex rig system. They're too big. You don't just bring them to the shop, right? They're not a car. You can't just turn them around and bring them into the garage. But they can throw them all down into the dirt, unstack the rig, and fix whatever recall there could be. I've seen that take out an entire fleet of rigs. Other than that, some major significant thing on a brand new rig system, nothing else should take out enough rigs to change the count enough to be considered shock and awe. As we do it every Friday, we want to take a look at next week's range. So the weekly expected move here in green, this was this week's weekly expected move. And I've always argued that the ES really just, this tool doesn't work good on the futures. It was designed to be made available for the SPX, not the ES. We use it everywhere, right? We use it in any market we want, but it was designed for the S&P. in the SPX. And it doesn't always do a very good job. You're better off getting the data yourself, just coming in here after the close on Friday and recording it next week's expected move value manually. And you would be even more better off if you used the SPX rather than the ES, but we'll use what we got. You can see that next week's projection is just a little bigger than this week's. That slight difference is about 15 points. That's the way it is right now, but what we really need is end of day, right? So we still need to wait, let this market close, but I like to get ahead of it and kind of see what it looks like on Friday morning. Be better to see what it looks like when the SPX opens at 9:30. So we got the 10-week here, and we're asking how far away from the 10-week are we? About 1% underneath the 10-week, and that's not very far at all. We have the capacity or the potential to move 4% before we could even consider that we're even slightly oversold. So plenty of room to the downside. Take a look at the daily. We're 2% underneath the 10-day moving average. We could go another 1.5% before we start to feel that we're getting into that average reversal zone. So we do have room to the downside, but we're likely going to bounce off of a support and pull back a little bit in the next week. And that makes sense, right? Because markets just don't fall in a straight line. Well, we wouldn't want them to. Volume's a little heavy this morning, which if this wasn't OpEx, we would be more concerned, right? But it's OpEx, so it's not a big of a concern at all. It's still within the boundaries anyways, because it's less than 200. So it is a little elevated, but not shockingly so, and not without a reason. So we're good. We can just get rid of that for the day. We have an MDP. We have not touched the daily pivot. MDP is missed daily pivot. It's not my strategy, but it is a strategy. Discuss the logic that markets hit their daily pivot more than 80% of the time. So when it doesn't hit the pivot, it actually becomes a notable tradable thing. 2 a.m. sell-off in the kill zone. I think we were talking about that yesterday. We did stabilize, getting a little bit of an inverse head and shoulders. It would only have the measured move to get us back towards the Globex open of last night around that 39.20. 21-day ADR is still underneath 2%, but close to. So we're looking at about a 1.9. We're at the ADR half to the downside. That's at 38.82.5. The full ADR would be 38.45. Taking it the other direction, the daily pivot is sitting on the ADR half on the upside, 39.57.5. And a full ADR, 39.95. But you would have to get through the cash open of yesterday at 39.76 to get there. An inside day breakout to the upside would be nearly impossible at this point today. Now, we don't want to say things like, well, price can't do that, because we know it can. Price can do whatever it wants to do, but it's unlikely that we're going to see a top side inside day breakout. We already are in an inside day breakout to the downside. So we talked about it for a considerable period of time. This range that we have been in, it's not done yet, but if we close outside of this box, how we open next week will become very important. Normally, we would want that nice topping pattern with the rollover and a gap down. And this outside bar kind of messes up the rollover. But what it reminds me of is this area right here, where we had that really nice outside bar, opened, gapped down, closed the gap, and then away we went. So we really need to see how it opens next week. We need to close outside the box, and then we need a nice continuation open. And I say that because, even though my box now is drawn on that red candle, it wasn't for a long time. We were using this doji. And we had a candle close outside of the box, and we're on the weekly. So that was a weekly close outside the box. And it opened up the very next week and just dumped right back in again. So just because we closed outside the box, that's not enough. It's also how we open in the new week. This could very easily gap up over the weekend, open Sunday night, and come right back up inside that box again. So if you're looking for shorts, you should certainly be, nibbling at this point with some short plays. But I'd like to see how the next week opens before I start to really size up. The Dow is high on my list for any new trades. That'd be a nice short to add at this point. On this rising wedge, I did a video on this when it was right there. Pointed it out. Okay, we got a rising wedge, we got our breakdown. It's very unusual to see something break down like this and manage to get all the way back inside the wedge. This is very likely going to be our breakdown. And if we do see a rally, it should be a rally into the underside of that trend line, looking a lot like a Busby before rolling over. There's the Busby, or, looking a lot like a Busby, coming back into the underside of the trend line, and there's the rollover. It's doing what it's supposed to do at this point. But that rising wedge breakdown right there is still midweek. So, the caution was be careful. This could whip back up against you. If you tried to go short right there, you're feeling the pain. So when we say wait it out, wait until you get the signal, wait till the candle closes, wait till the candle closes. Yeah, the diamonds DIA. If you look at where they are at on the year, they made it above that August high, right? Or they made it above this candle right here. The S&P didn't do that. We're not even close to it. That same August pivot. We're like halfway. So who's got more room to fall? The diamonds. The S&P is the most liquid thing ever. And I really like to day trade it and short duration trade it. And I'm constantly in and out of this thing, whether it's in the futures, options, SPY shares. I'm in and out of the S&P all the time. But the Dow as a swing trade really looks like a great play. It has more room to fall. And it seems like it's been a little bit of a safe haven if you look at some of the names that are in the Dow and how good they look. You know, this thing has been a nice little place to hide between Caterpillar and Pepsi and McDonald's. Yeah, 30 names in the Dow. It is also a different index entirely. There are price weighted indexes, and then there are market cap weight indexes, right? Cap weight indexes. So even the formula for the number that you see on the side, you know, how the Dow is even calculated, how it is affected by the names that are in it. It's because it's a different index entirely. But for a short, for a swing, I would rather swing the Dow and continue to focus on short duration, short-term trades in the SPX, especially because of the liquidity. The Dow is not necessarily, you know, sexy and glamorous when it comes to liquidity. It leaves it a little bit to be desired. It's enough to be tradable, but, you know, and that just kind of sums it up. But I'd rather not day trade this thing. We are outside of the box. When we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. And when we get out of the box, we expect to get back inside the box. It has a long ways to go before we start to lose this point of control at 39.31. That is a significant level. It's a cog line. It's a quarterly level. It's a weekly level. It's a daily level. There's so much structural support and just structure at 39.31. And we are below it, obviously. Getting back through it is going to be a tremendous chore, not likely to happen anytime soon. Wicking through it, yeah, sure, we could punch through it on a wick, dance around it a little bit, but I don't see that we're going to get through it onto the other side of it with the econ that we have on deck today. So once we get through the morning, there's really no reason to anticipate we're going to make it through there unless some other news comes out, right? And it would be shocking news. It would be unknown news rather than known news. It just sounds funny to say that, but that's the way it is. The VPOC that we were carrying from Monday is done. Took that out yesterday, and it's worth noting how price reacted around that level, right? And it's, as I was talking about yesterday, these are not support and resistance lines, right? They're just goalposts, milestones, places where you expect to see price respond to something. You wouldn't want to try to go short if you're really close to the VPOC, right? You'd want to look and see if you can get past it first before you would short. That kind of logic saves my account all the time. You know, don't short from the hole, especially if you're really close to the floor. Point is, we don't need that VPOC line anymore. We're done with it. Take it off the board. We don't have a VPOC from yesterday because we've already ran through that zone a few times in the overnight hours. We have one underneath us at 37.90, but unless things get really nasty today, that's kind of not on the table. it is worth noting how far below yesterday's level we are. We are inside day breakout. And what we sometimes see, especially after having moved this far, is a pullback before continuing to go lower. We need to be careful on how far down we go in the pre-market. The reason for that is if we look, see if there's a good one. Yeah, here's a good one. Take it back to February. And even in January, where you had one of those days where we really sold off and then rebounded back up, 200 and something points in a single day. Or here where we opened negative and we fell more than 100 points and then ripped it back up 250 or 150 by the end of the day. Those really deep sell-off in the overnight hours in the Globex offer a whiplash back in the other direction. We don't have that. We're not down that far this morning. But if we continue to fall deeply before the open, we start to get set up for one of those significant reversals, especially on a Friday. So we got OpEx at the end of the day today. That's going to screw up all of your volume metrics. Sizzle won't work today. Basically hasn't been working all week, but it's definitely not going to work today. So since we're only mildly down in the overnight, we're only down, 1%, which sounds funny to say. Pre-COVID, if you just said something like that, everybody'd think you're crazy. It's only 1%. This inverse head and shoulders measures back up to the bottom of yesterday. It wouldn't surprise me at all if we come into the open and we try to reset this liquidity vacuum. I know this doesn't look like a gap, but when a market moves really fast, it creates a liquidity vacuum behind it. It's why we popped so high on CPI day, and then we spent all day unwinding the move, just closing the gap. So we could see the market try to work its way back up and attempt to close this gap. Getting back above 39.11 would be the cog line and would be the start of it. And then looking for the other cog line at 39.31, which is a significant level of resistance that we don't think we're going to get back across anytime soon. So you could see a nice little bump up first before rolling over and continuing to move to the downside. We hit support, so it makes sense that we're going to rally into a resistance zone before rolling over. Seen some odd stuff, and I don't know what to do with it. I just definitely want to point it out. So we had that move in the kill zone last night, that 2 to 4 move, but we had the same thing in the dollar. So it didn't happen because of the dollar. It happened with the dollar. I don't know what to do about that. The VIX did respond, which is good. At least one of these two tools are working. But generally, if the dollar had sold off like this a month ago, that would have been a spike in the other direction for the S&P and the NASDAQ. Now, I wrote in my weekend report, last week, maybe the week before, we're going to be looking for a decoupling between, oh yeah, I am looking at the SPY. That's supposed to be where the dollar is. Thank you. Let's put the dollar there. That makes more sense. On my other screen, when it was too far away to read on my other screen, the little symbol, I expected SPY to not be there. Should have been the dollar. That freaked me out, guys. I'm telling you, last night when I was looking at, or this morning, this move down was matching that move down in the dollar. I thought, oh boy, here we go. We're finally getting that decouple we've been looking for. Good. For some reason, I had a dollar. I did not have the dollar there. So never mind. We don't need to worry about it. We haven't disconnected. Yet. But like I wrote in my weekend report, that disconnect is coming. We are going to see the dollar move in the same direction as the S&P and the NASDAQ. It's going to happen a little bit at a time. It's got to extricate itself. And it's going to look a lot like what we were just looking at, where even though it was SPY, it'll be a move in the index and it'll be a move in the dollar, and they'll both be going in the same direction at the same time. Continue to watch US dollar Japan and US dollar China. We're coming into a significant level. Now we broke it on US dollar Japan, and we got that monthly underneath us, or over our head. So a rally up here would be a rally in the dollar, but it would likely match up with the dollar in yesterday's high. So we're going to be looking for the dollar around 1048. Fail this inside day breakout around the same time that we're looking for US dollar Japan to come up into this monthly resistance and stall out. A breakout on the dollar above yesterday's level should be accompanied with US dollar Japan getting above that monthly level, which would mean that this exponential moving average provided the support that we were looking for, as it did back here. That same move up should be accompanied in US dollar China, which also has a monthly restrictive level right around $7, or $6.99. Going to be looking for the VIX today to be our benchmark along with the dollar. ES below 38.7, with the dollar pressing above that 104.8. If we get a breakout in the dollar, we should see the ES leg down to that 38.5. And the dollar above 105 should put us right around that 3,800. So if you're trying to match the numbers from what I do here to the SPX, forget numbers. Keep in mind that we use percentages for a reason. What's the percentage basis? Right? You can't compare Oreos and Ranger cookies. You got to turn everything into apples and apples. All right. And the way that you do that is by using percentages. So if you get rid of the numbers completely on the side and you focus solely on price structure, imagine what that would look like, right? You would literally only be looking at the price action itself, and you would not be looking at the date on the bottom or the price on the side. If you did that, you wouldn't need to worry about, well, the ES is at 39.95. What is the SPX number that is going to correlate with that? Instead, it would be there's resistance at yesterday's high. If I go over to the SPX, where is that resistance going to be? The same spot. We're going to open gapped down this morning in the SPX. And if we try to move up, what are we going to hit? Yesterday's low. Do I need to write that number down or point it out the correlated difference between this at 38.80 and the ES at whatever its low was yesterday? Or can you just recognize that that's the same spot, 38.70? See how it works? It doesn't matter what the number is. It matters what is the shape of the candle. What is the shape of the pattern? Is it trending or not trending? And then if you measure 2% on the ES, what would you do with the S&P? Measure 2%, or you'd measure the size of the box, right? These are not moving in lockstep. They're right now, the futures, I say this, but it looks like we just changed it in the overnight. There was a 30-point difference yesterday between our real S&P index and our March futures index. Why? Because in March, they see the market 30 points higher than they see the market right now. It's called the futures for a reason. Where do you think we're going to be in March? 30 points higher than this. That's no longer the case. Looking at it this morning, we've gotten rid of that 30-point separation, but we still can't look at these and say, if the ES goes to 3,800, what's the SPX going to be at? Instead, you have to just literally do your analysis on the SPX. $38.59, $38.11, which happens to also be a cog line. $37.50. $38.71, $38.41. And I'll just leave this there for a second so you can take a screenshot. You can add these levels to your chart. They're going to be levels that we interact with. If we continue this move to the downside, just keep in mind, we've already fallen a long way. We've crossed through a critical must defend level. Seriously, they have to defend this level, or we're really going to head to the downside. And since the week isn't closed, we can't say that they defended it yet or not. It was supposed to happen at 30, 39.30, and it did yesterday. They defended it to a point. They couldn't defend it anymore, and then we went to 3900, which was another level. They defended that for a while, couldn't keep it, dumped it again. You got to 39.80 yesterday, which was another level to be defended, and that one held. But here in the pre-market, in the ES, we've seen that it didn't hold anymore, and or we're back down to it, right? Because we rallied up off of it yesterday. So that 38.80, if it had broke, we were headed to 38.50. It didn't break. We rallied back up. But in the ES, we can see that we've punched through the low of yesterday, and we've already expanded to the downside nearly 1%. So as we come into the SPX open, we're very likely going to be opening whatever percentage to the same thing on the downside, right? Don't think dollar value, think percentage value. If the ES is down 0.75% as we come into the open, the S&P is going to open around 0.75% as we come into the open, right? So it'll be a simple thing to just use your drawing tool and stretch down 0.75% or whatever the percentage happens to be. I don't know if I can take a picture while it's still doing that, but no, it doesn't let me. Haha, I got it. So on your drawing tool, before you finish snapping the line, if you just click a spot and then you drag your line wherever you want it, while it's still in dynamic mode, your drawing tool offers you your percentages. So right there, when the picture was taken, I had it drawn about 0.8. Now, you can go in and change the settings where after you snap the line, that still shows. But a lot of times, I don't want it to show afterwards. I just want to measure how far I need to focus on, right? So as we come into the open, look at how far down the ES is, if we're still down at the open. And you'll have a pretty good idea of where we're going to be opening in the S&P by measuring that same distance. The percentage that we are down is right there. And you can get labels and indicators and all kinds of stuff that'll tell you how far we're up or how far we're down, but it's at the top of your screen. Percentages are the solution to your problem, right? Not trying to correlate it with price dollar values, because that won't ever work. All right, nat gas is giving it back again, still continuing in this range. One of two things we're looking for here. It's still in the box, so I don't want it, right? We need it to get out of the box. Either a significant break below 19.25 for a short play back to 17, or we find support at 19.25 and we just run back up to the top of the box. I'm willing to run it back up. Probably not today, or I mean, as a swing, probably not today. As a day trade, sure, I'll run it back up off of 19.5. So there is the possibility here for a nice play. It's got the support that we're not looking at in a lot of other markets at that 19.5, 19.25. Watch for a little bit of trickery. Remember that they needed to go lower than the previous low to have a really good double bottom, right? If it goes only to the previous low and bounces, that's not as good. Liquidity resides on the other side of the market. So we need it to come down, pass through the pivot point, get into the liquidity, and then bounce back in the other direction, which is difficult because if it's actually breaking down, it's also going to go into that liquidity. And then we're going to get, a rally into resistance and then a continuation to the downside. Solar is still sitting in the middle, but it does have that support around 78. Depending on how far we can get today, and we are opening gapped down in this again, but depending on how far we can get today, I'll be looking more for how we open next week. You can see we're really close to making a decision here, and Nat Gas, it's a really nice rollover, but on the week, I don't want to see this green candle, right? I really kind of want to see this resolve today. So if we can get down below the open on the week to where we end up with a red candle, I would like this a lot better. I don't think we're going to get below 78 today. But how we open up next week, this will be really nice for a rollover play. All right, TLT inside week is very likely going to be what we get. It could rally today and take out that 109.71, but we're down on the day around 107, 107 and a quarter. So it's kind of hard to imagine we're going to get outside of this box. This will put us in IX10 weekly. That's our box, and we need to get out of the box. Bonds continue to improve. We're seeing a lot of money flowing in that direction, a lot of posts, a lot of media, everybody pointing out that 2023 bonds are expected to do way better than equities, and everybody's piling into it. It's getting crowded. It's getting really crowded, but I don't think it's done yet. It certainly made a significant run off 92, and it's likely to chop about here for a while. As long as it maintains above that 104 line in the sand, I'd say you could continue to stay bullish in this and look for opportunities to swing it to the upside, either by coming down and bouncing off the 104 for a new play up, or by breaking out above 110.22, which is this gap close that needs to be resolved. Above that, 113.62 is another gap fill that needs to be resolved. So at least with now, you've got two different ways to approach this one, either bouncing on support at 103.85 or by breaking out. If we stay in the range, or we have an expectation that we're going to stay in the range for yet another week, that's not a really big range and might be a nice candidate for an iron condor. We are, looking for a little bit of digestion, consolidation, basing. Could get another week out of it. Something to consider might be really cheap butterflies, like 1 penny butterflies at any of these structural levels, 103.85, 110, or 113. Obviously, you can't put options at 85-cent, butterfly at that spot. So you'd have to make a decision if you're going to go with 104 or with 103 half, because I think this has 50-cent options. Yep, 104 half. So butterflies have a very, very low win rate, but it has a really absolutely amazing risk reward. And that makes perfect sense because risk and reward are inversely related to the win rate. The higher your risk to reward, the lower your win rate, and vice versa. So butterflies have an insanely amazing risk to reward, but an insanely horrible win rate. So, anticipate winning like 15-20% of the time. Surprisingly enough, though, when you do win, you can make so much money, you cover the 80% of the time that you lose. It's a 2 penny trade, and depending on the broker that you use, if you're not using commissions, that's awesome. If you have to pay commissions, you're going to pay more commissions than you have in debit. And that doesn't make much sense. So you might as well make the butterfly a little bit bigger, because if you have to pay debit on the darn thing and pay commissions too, make it worth your while. Rollover in the XLF with a nice gap down after this one bar here, this doji bar. This does not, it didn't line up like a evening star reversal the way that we would want it to be, but on the weekly with this really nice run up and the indecision bar here where it didn't work and we continued higher, this is why we say wait until it opens in the new week. This looked like a perfect reversal. I mean, especially at the close of that week, it was like, oh yeah, we're going to reset this thing and come right back down again. And then it opened there and the whole trade was just negated. We were just done with it. We didn't trade it and we avoided a loss. On this week, when it closed, it again looked like, oh yeah, great short, perfect opportunity. We still need to see how it opened into the new week. And it opened, gapped down, and away we went. That gap still exists. I'm using the top of this candle because it's an open red hollow candle showing that we gapped down and then rallied up and closed higher than where we opened. So we were down on the day compared to that green day that we had the day before, which makes it a red candle, but we closed higher than we opened, which makes it a hollow red candle. And since we did not get back to the close, the gap still exists, but they sure gave it a heck of a run this week to try to get that gap closed. We need to see if you're not in this now, you've already missed a pretty good size run. We need to see if this is going to consolidate at 133 or not. So how we open into the new week matters. Let's see how the new week opens. What I'd like to see coming in on Monday or Tuesday is that we open gapped up on the week. And as long as we stay below $35, then we're going to continue to focus on running this back down to about $30. XLK, you know, this thing is not as liquid as we would expect, but if you're, you know, trading singles or you're going to hold the spread until it gets close enough to expiration to have the liquidity to be able to manage to get out, then downside targets, we really need to open next week before this triggers, but we want out of the box. And I was sloppy with where I drew that box on the top side, mainly because, well, we're not worried about the top side. We need to open below 128.7 next week. And honestly, it wouldn't bother me at all if we open gapped up first and then we dump. I would kind of actually like that a little bit. But either way, we need out of this box. Targets would be 123, 118, and then 112. I'm on a weekly chart. It's going to take time to make that kind of a move. We're looking at like end of January kind of stuff. Just keep in mind that the moves might come really fast and then they're going to be done. You know, it's going to be this really steep, sharp, fast move in a lot of these indexes. And then it's just going to stop again and consolidate. It's not going to continue. We're already outside of the box. I'm going to move this for a minute so we can see what I'm measuring here. This is consumer discretionary. It's got a lot of Tesla in it, which explains part of the reason it's down so much. It makes it hard to trade because of the Tesla being in this. But otherwise, we do have our breakdown. It needs to close outside of that box, which I don't think is going to be very hard at all. And then how we open next week should give us the continuation signal that we need for 131, 124, and 117. Again, not happening in 1 week, right? This is going to take a while to unfold. We are right at the lows here on the year. which is significant compared to say the S&P, where we are nowhere near the lows of the year. Same thing with the Russell. Healthcare rallied into resistance, couldn't get past it. We really want to see how this opens next week. We don't have a really nice reversal candle like an evening star and then a gap down. We don't have it at all. Instead, we just have this collection of trash. And I'm going to argue that if we're still in the 135 or above, I wouldn't try to short this. So either another test of 142 would be short against the high. I like that. Or we get down below 135 and then we short it to the downside. Because the danger or the risk here is that it's going to find support and do like a Busby play, bounce off that 134, 135 and rally back up. So, you know, you could short it from 137 to 135 or a little lower, but you're in the middle of the box. I mean, you know, don't diddle in the middle, get out of the box and then take the trade. So long off the edge, short off the top, let it Busby and do something. Otherwise, I don't like it. I do like the whole idea of running healthcare back down to 120 through next year. And I mean, look how strong it is. If we're going to get a short going in here, it's going to have to prove that it's no longer strong. Otherwise, you know, we're just taking a shot on faith. We don't even have a rollover pattern. XLI, it's got that trend line underneath it for support around 96. Let's see if that holds. We got a beautiful expansion bar here, right? Big old bearish engulfing, covers weeks of candles. How we open next week's going to be great, but you know, I really want to see it prove to me that it can get through this trend line. And then we got a nice short. Plenty of room. Nice short. No reason to get in a hurry on this. Let it get through that trend line first. And again, you know, if you're day trading or short duration trading and you just want to run it to the trend line, yeah, I mean, yeah. I'm just looking at a bigger, something to hold on to for a while kind of trade, swing. And these are not overly liquid products, by the way. They do have weeklies, you know, that's fine. But when you go in looking at the options, look at where the open interest is at and the volume so that you're not sitting in some isolated strike that nobody else is trading. Try to gravitate towards where the institutions are at because at least there's liquidity there. XLB, we're at that 79.25 trend support. Again, no rollover pattern, right? No reversal pattern, nothing like that. All we've got is some chop across the top and a big area of consolidation, just like we have in basically everything right now. So to me, it needs to prove it. A break below 78 would be a good start. That would be a good trigger to the downside back to around 70 or 68. It takes some time to get there, right? It's not, it's a weekly, it's going to take time. If any of these bounce and run to the top side that we were talking about for shorts, then it would be a short into resistance, which is nice because then you're going short off the highs instead of short off the lows. At some point, I seen the VIX was up 11% yesterday. I don't know what we had total. Yeah, 11.17% from low to high yesterday in the VIX. It woke up. There was a video on stockcharts.com. I tend to watch a lot of their videos. They're like stock TV all day long. They've got stuff playing on their app, and usually it's breadth related information. It's I've learned a lot about market breadth from watching their videos, but they had a video on the VIX yesterday. Looking for the picture here. Volatility divergence is what they talked about here. Now on the right-hand side is where they have their notes. And what they're basically saying is every time the VIX gets to be right around $34, that tends to be where the S&P bottoms out a little bit. Now, that question earlier about getting S&P levels for the ES, this is exactly the kind of thing you would want to do in the same idea, right? That one is a topping pattern, the other one should be a topping pattern for the ES and the S&P. One's in a bottoming pattern, the other one should be in a bottoming pattern. Here, they're just inverse markets. So every time the VIX topped out at that $34 area, the S&P was bottoming out. The dollar value didn't matter. It didn't matter where the S&P was at. It just mattered that that was going to be where we would expect to see a bottoming formation, a reversal pattern. Because the VIX was getting into 34, the S&P was supposed to be showing a reversal, which it did. Then the VIX would get to $24 or $20, and the S&P would top out. So topping pattern, bottom pattern, topping pattern. Earlier in the week, earlier in December, the VIX got down to that $20 level, started to roll over and make its way back up. And then instead, we got divergence. And we actually had the VIX going down and the S&P going down at the same time, which was really frustrating to a lot of people. But Tier 1 Alpha explained earlier in the week that that was very, very likely going to happen. The volatility was so high over the uncertainty of the FOMC itself that no matter what they said and no matter what the S&P did after what they said, VIX was still going to get crushed. That was almost a foregone conclusion. And that's what we ended up with. So then it took a day or two for the VIX to kind of recalibrate. Think about if you've ever gone fishing, you throw your line out there with a bobber in it. The bobber goes under the water when you first cast your line. There's just so much weight and inertia on the end of that line. It hits the water, it goes down, then it bobs back up, and it does at that point what it's supposed to do. The VIX got shook around a little bit. It took a day or two for it to stabilize, and now it's doing what it's supposed to do again. So this divergence is likely going to end, at which point we'll focus right back on we hit 20 in the VIX. That's supposed to be a topping pattern in the S&P. We're going to expect to see a rollover in the S&P and a continuation in the VIX back up to 34. And I'm not taking any credit for this. I didn't make it. I have nothing to do with it other than I'm sharing it. I have no reason to try to pass somebody else's work off as mine. I believe the video was the Daily 5 because I can see the word daily down there. It's Stock Charts TV. You can find them on stockcharts.com or you can watch them on YouTube, whatever. Really, really good insight here. We're looking at the dollar on the weekly at the 50. We're right around that 104, 103. This has to hold. There's already been a lot of funds and analysts coming out saying that the dollar is done. I think that's a little premature. But we're going to know soon if we break that 103. We're getting close to the 50% mark. If you measure from the low to the high of this run, The 50% mark is at 10, basically 102. Now, I'll argue, like I always have, that a trend should not pull back more than the 786. Textbooks in technical analysis will say as long as it didn't pull back farther than the 618, that's fine. But I argue with that. Those books are really old, shared back in a time frame when data was not readily available to people, and you had to work with either delay by days or delay by weeks. And so you gave markets more room. Plus, traders themselves just couldn't respond fast enough. So 618 made sense. In the modern world, that doesn't make sense anymore. 786 is a more accurate representation of a trend. But just because a trend is no longer alive, and I argue that the dollar killed its trend when it broke that 786 and closed below it. That trend is dead. But that does not mean we're bearish, and it does not mean we're in a bearish trend. It just means that this uptrend is done. That 1.5 year long uptrend is over. We could start a new trend. We would have to get above 115 before we actually start calling it a trend, but we could start running back up again. Another thing about this run back up is the fact that it would be a head and shoulders. And it's what we would expect to see anyways. So whether we're going to continue to the downside or we're going to start a whole new trend, either way, we expect a rally back up to around that 106, 108 area to either give us the right shoulder or to start the trend back up. If it breaks 103 and starts moving to the downside, it'll negate the whole head and shoulders, and it'll just be this continuation pattern of falling and falling. It's worth watching. The main takeaway is we're expecting a rally in the dollar. We do have a descending 20 and a slightly descending 200 overhead. And those are usually going to be where we rally into a resistance. So watch that 105.5 as a significant level of resistance. And of course, we can shoot through it. We can overshoot to like 106 and then drop down. Either way, we're holding an expectation that we're going to see a rally in the dollar, and that should equate to a fall in the S&P. Just remember, at some point, as I started writing last week or the week before, we will begin to see a decoupling here where the S&P goes down, the dollar goes down with it. Other than FOMC, that argument kind of holds already. We got to see it unfold more, though. So what I got for you guys, be careful, be safe. If you're looking for something this weekend worth studying, convexity is a great word. It's used in the market a lot. It sounds complicated, but it's not complicated at all. It's just a really fancy word. But convexity would be something worth looking at this weekend, because we've been in this state over the last 6 weeks or so, where if you were running either or trades, you were getting squished, right? Because the market really wasn't doing anything. It was staying in this range. And those convexity trades, they really only work if we actually go somewhere. And they are losers if we stay put and don't go anywhere. So it's a great one to add to your arsenal. It's a great thing to take a look at. And there's plenty of information out there on convexity. Everybody be careful, be safe, have a good weekend.